Thank you for coming, man.
Yeah,
Appreciate
no problem.
this.
Good to be here.
You know, I reached out to, is it Andrea that does your social?
Amanda.
Amanda, pardon me. So I'd reached out to her. God, it was months ago, and I don't think I realized that you weren't actually in Calgary. But so she had said at the time was like, okay, well, you know, let's follow up next time he's in town. Usually when you hear that, you're like, oh, they're gonna fight, right? So it was great. It was great that you folks followed up and said, hey, I'm gonna be in town. If you want to do this, let's do this. And so here we are. Yeah. Maybe start by introducing yourself, if you wouldn't mind.
Yeah, name's Dustin White. I'm the acting CEO of the Dynamic Group of Companies. Dynamic Capital Equipment Finance is our go-to-market brand right now, and we specialize in anything to do with commercial machinery. So span the industries of trucking, transportation, construction, aggregate, energy, mining, anything, as we kind of say, tracks, wheels, and wings. So I guess I forgot aviation. Yeah.
Oh, you do planes too. Okay. What makes there are several equipment lenders out there, right? Dedicated equipment lenders, and oddly enough, I feel like all of them worked at GE Capital for some period of time.
Like McDonald's.
I didn't appreciate what a big business that actually was before GE got rid of it. But there are, there's Dynamic, there's Essex, there's Arundel, Valiant. I'm skipping countless ones. Yep. What makes one different than the others?
Great question. I think from our perspective, it's kind of what they specialize in terms of profile, asset, deal size. Some of them that you just mentioned, probably have some nuances to what they really want to originate to put in their own portfolios. So there's some lenders that really focus on small ticket, micro ticket, others that look at mid ticket, others that look at more turnaround, restructure, refi. So I would say that's kind of where you would start to kind of figure out what the differences are between some of those shops and others.
And where does Dynamic fit on that scale? I guess there are a couple of different ones in there, but
yeah, it's again great question. We're kind of as we would say, a full spectrum lender. So we compete against all of the prime shops, bank leasing companies, credit unions, all the way down to, again, some of the more storied credit, turnaround, restructure, situational circumstance. And we kind of cover the full rate spectrum. So, everybody's got their different letter grading, but, probably a AAA all the way down to, kind of a C would be kind of as far as we would go. We kind of stop at, hey, does this business have a future? We don't like to come in and look at funding liquidations. If we think somebody's going to liquidate, I mean, honestly, from a moral and ethical perspective, we'll just tell them, like, you know what, we don't see a future here. You're probably better to be in control of a wind down than, handing the keys over to a lender and asking them to do that for you. But we really do everything in between. Again, from first-time guy going in to buy something to somebody that's been around for 40 years that went through a difficult time and just needs somebody to believe in their turnaround plan and come in and, maybe structure some capital that somebody else in the market isn't comfortable doing.
What's that new group called? Is it Progressive? Yeah,
Progressive Capital is effectively just the name of a facility that we're using to really structure those turnaround, refi, situational circumstance. So it's kind of just a brand within our business that is being used to kind of, create some visibility to that specific type of financing, which we kind of refer to as structured finance.
Is that, pardon me, what am I trying to say? Is that giving you exposure that you wouldn't have previously had? Like, is it moving up the risk curve a bit?
It is moving up the risk curve and also up the deal size curve.
Mm-hmm.
Larger holds, holding more credit risk as opposed to selling or syndicating some of that stuff. Because again, we do have our own direct lending book, and then we still do club and syndicate transactions with other parties as well.
Yeah, I remember on that one deal that you folks looked at for us, like we were looking at 30 million probably all in, and it was big for everyone. When you club or syndicate something like that, is the customer aware of the other lender, or do you shield them from it?
We're a fully transparent shop, so if we're coming in on a large transaction and someone else is coming in with us, odds are, the client is going to see who that lender is.
I just mean, sorry, what I mean is insofar as, are they going to have to go and deal with these folks and get a request and these folks and get a request? And
again, great question. The short answer is yes.
Yeah.
When it's a full notice, full disclosure club, generally speaking, lenders are going to want to chop up the collateral and the security, so everybody has a margining base and a payment stream. Because as a lender, that's what you're effectively going and getting your funding matched against.
Mm-hmm.
And so really everything goes back to who the end lender is, which generally is going to be banks, life insurance companies, pension funds, securitization conduits. And they're all going to mandate their lenders to have specific collateral and specific cash flows that they're effectively margining or selling.
Mm-hmm.
So yeah, from a borrower's perspective, when we're leading the club, we're still effectively the lead arranger. So we manage our own assets accordingly and generally manage the Q&A or the releases or the request to the counterparty on behalf of the client. And
do you have a size, like an upper threshold for size, or is it entirely dependent upon the deal?
Our portfolio is built upon, some metrics that we have to maintain where, single concentration can't be above X percent. Generally in today's dollars, our on book is just over 200 million. So our largest clients owe us 3.5 to 4.
Okay.
Which would be obviously a fairly sizable sum. Generally those relationships don't happen overnight either. Those clients are the ones that, we've had a few years of history, pay down, transactional business with, where you kind of work up to those levels. Going back to the progressive facility is meant more for onboarding those larger holds out of the gate. Because in that workout situational circumstance, generally speaking, like $1 million doesn't get you very far in today's day and age. If you're not able to underwrite 3, 4, or 5 million, you're just not really sitting at a lot of interesting deal tables.
Yeah, especially with the state of the equipment market, right? Like prices have just, you would know better than I would, but prices have changed so dramatically in such a short period of time. We had 2 appraisals over, I think it was like 12 months. And what was fascinating was that the values, despite the fact that you were putting on hours and mileage, the values actually went up. Mm-hmm. And I wouldn't have thought that was even a remote possibility, because usually when you're in the bank, you assuming a useful life on these assets of, I don't know, call it 7, 8 years, whatever the number is. Mm-hmm. The assumption is it's got zero value, decreasing value over time. And so it was interesting that that's not really the case right now, or at least it wasn't, a year ago.
It's a fascinating market in terms of what's happened kind of post-COVID.
Yeah.
Really kind of go back to that being that it's almost just like this delineation between what was normal, and now we're dealing with, on top of that delineation between, again, to your point, assets potentially appraising for as much or more than they did 12 months ago. Now you have new pricing that is up in some cases 20, 25%. I mean, we're doing certain asset classes right now where, a brand new piece of logging equipment might be $1 million. A couple of years ago, that same piece might have been $750,000. And so just that inflation, so that your replacement cost of that new unit has gone up so much that kind of starts to make logistical sense as to why a used piece with low hours that's the next best alternative is going to hold up, because that customer's switching cost or switching option has gone significantly up in price.
If the used equipment market is anything like the used van market, I'm guessing it's still pretty tight too.
It is. I think the feedback we get from customers is that, candidly speaking, junk is still junk.
Yeah.
But the newer stuff that's close to a new machine is holding up quite well. There's certain parts of the industry that are definitely in more challenging times than others. But construction specifically, we're still seeing really good strength in pricing.
You made me think about some customer conversations I'd had, and it seemed like speed was a really big factor when they were picking lenders, particularly now, because if they come across an asset, they kind of got to move ASAP. And I got the sense that that banks generally don't excel on speed, at least with respect to their equipment facilities. And so it was commonly one of the early questions I would get from somebody when they were asking for an equipment facility was, can this lender do a sale and lease back? Which in my mind, I didn't really think of it as all that big of a deal, like, because all they wanted to do was buy the vehicle and get the financing 7 days later. Do you face that issue a lot?
It's one of the reasons we exist is speed. Customers that are, as we say, I have a client that likes to use the term, I need to move and shake. If I need something, I need it. Like, I've got a job that starts Saturday, I need it on the road Friday. And it's one of the things that we do excel at, of being able to give that customer an assurance, given the right scenario, that, yeah, it's Tuesday and I can fund by Thursday. And again, given the right circumstances, we can do that. Customers don't generally like to wait a long time to get revenue generating assets generating revenue. Yeah. By definition, they want to have that thing out billing an hourly rate and, doing a job and, hopefully contributing to their business. We believe that banks associate speed with risk, because the natural question that risk managers inside those institutions ask themselves is, why are we in such a hurry? Mm-hmm. Right? It's almost counterintuitive. It's why wasn't there planning and foresight, and where's the CapEx budget, and right? And for small and medium-sized businesses that are operating on I just won the contract today and it starts Saturday, to them that value proposition is, can you fund in time?
Yeah, it's there's some real truth to that, especially because a lot of the people that, including myself, a lot of the people that I knew in the bank, none of us had ever actually run a business. There might have been a handful, but generally speaking, like, we didn't have the empathy required to really appreciate, especially the smaller companies. Yep. We didn't really get where they were coming from. Like, how do you not run a CapEx budget? Perfect example, right? Like, sometimes the owners are great operators. They're not necessarily CFOs though, right? And so there's a gap that we couldn't comprehend because we'd just never been there.
Yep.
Do you know what I mean?
Yep.
So I definitely think it would be ideal if every banker had to have been a business owner before, but I don't know how that's logistically possible, right?
Well, it's funny because, again, I worked at, not a bank, but worked for GE, and, there can be that, I guess, culture inside the bigger organizations of, we're a big corporate, entity, and this, smaller entity should be doing this and should be doing that. And at the end of the day, you don't really know what that looks like until you've gone out and started a business or done something entrepreneurial on your own. And it's an interesting relationship between borrowers and lenders, because generally lenders have, significantly more influence, right? Or they have the control over the capital that the borrower is looking for. So
especially because, generally irrespective of what type of lender, like, lenders want to help the customer, but at the same time too, like, they have to balance the credit department, and realistically, like, who's paying the paycheck, right? Yeah. So they're not necessarily going to get the customer the best terms as quickly as possible. Certainly not to the extent that the customer wants. Yeah. That creates some friction, unfortunately. And having smaller companies like you, small is not a bad thing, or nimbler companies. Yep. Like, there's a need for that out there, right?
Yeah, I mean, we're trying to fill a niche. I mean, we say we're kind of the mouse dancing below the feet of the elephants. Honestly, I mean, in Canada, the banking sector is still a gigantic oligopoly. There's very little difference from our perspective, from what we see, from who we compete against. You could put a variety of different names at the top of the proposal or the term sheet, and they're going to look generally the same. If you look down in the United States, for example, like, the banking market is just so much more fragmented with the regionals and the independents and the, savings and loans and all that other stuff, that, customers just have such a different experience in terms of what type of capital is out there and what exists. And, Canada's just a lot more plain vanilla.
Yeah, that's fair. You'd mentioned that you guys do some aviation. I guess the question there is, how specialized is too specialized when you're financing assets? Because obviously you're looking at each of these assets with the view of reselling them somewhere, right?
So aviation, just to clarify, we've looked at, selling, brokering, syndicating those transactions.
Okay.
We don't have the ability to hold that risk. And really just because we don't have a lot of experience, to your point, in underwriting the collateral. Aviation assets are effectively rebuilt as they're used. Components time out. You have to update virtually everything in the machine over time. And so effectively you can have an old A-Star built in the 80s that is still selling on the open market for $1.5 million if all the component times are low. And so again, we don't have a ton of experience there, but it's definitely, they're fun deals to work on, simply because, we kind of look at them as big toys, right? Biz jets, we've done some of those, and, honestly, I got to ride in one after we helped place it. They're just, I don't know, kind of neat, fun deals. We've done some rotary deals on helicopters and, working machines as well.
Like for the rotaries themselves?
No, we call them rotary just because of blades spin on them. But yeah.
Can you tell I've never financed one?
Okay. And again, it hasn't been a lot, but those deals have been fun. It's you always learn something new dealing with a new asset class, industry, what type of regulations and security requirements there are, insurance requirements. Yeah, fun deals.
I can only imagine the insurance requirements get a bit rat's nesty.
Well, and just costly, right? That's the other thing that is kind of, in that same conversation about inflation and asset prices going up is all those inflated asset prices have to have inflated insurance values attached to them.
Right.
And again, if you look at some of the destruction in terms of, fire and flood and all the other stuff, I would suspect that insurance rates are definitely not going down next year.
Certainly yours.
Certainly. I think, part of your question there with respect to specialization of collateral is important. Specifically for small independents, generally our rule of thumb is if it's serial number 001, it's not something we're probably going to be able to do. Because you need liquidity of an asset. Unfortunately, as a lender, you always have to look at the glass as half empty, as part of your analysis. And you definitely don't want to get something back that has no secondary market. Or what we refer to them as binary assets. There's certain assets that in a good market in a specific industry are worth a lot of money, and in a bad market, they're worth zero. It's literally
like drill rigs.
They're never worth 50% of their value. It's either full value in a good market or zero in a bad market because there ain't no work. So those are the ones that, again, you have to really look at. And those are the ones where, we have seen other lenders take some pretty significant losses.
Have you seen, so on the specialized stuff, have you seen it, the OEMs stepping in very often to provide financing, or pardon me, the supplier?
The captives are probably some of the best competition that we have.
Oh, yeah?
Some of the in-house providers, Cat Finance, for example, fabulous lender, super supportive to clients, very pro-business. They finance a lot of their own product. It's very hard for us to finance that brand simply because their in-house financing option is that strong. John Deere is another strong competitor. And most of the OEMs on the construction side will have their own in-house financing. The more specialized brands, I can think of a few, kind of boutique captive providers that are supporting those products. But when you get into that, I'm not going to even go what we would call full specialized assets, but things that have a little bit of a specific purpose. That's generally a bit of a niche for us as well, just because there aren't those captive options to have to compete against as hard as we do on the more plain vanilla stuff.
Yeah, I've had some instances that come to mind, assembly line type stuff, distillery equipment. I was actually surprised by the distillery equipment. I'd never done it before, but I was like, surely somebody does this stuff. And the general feedback was like, we haven't seen it before, but we'll take a look, which isn't super inspiring.
That's super helpful.
So
we'd be happy to waste your time.
Yeah. Well, every lender wants the right to say no, right? So, and I definitely get that. But also instances where somebody's like, yeah, we just bought $75,000 worth of equipment. And then you look at the invoice and you're like, so that's like $150 per unit. which I don't think generally equipment lenders like, right? Like I think there's a minimum per unit that you're looking for.
Yeah, I mean, some of that stuff gets done again under that micro ticket, small ticket. And there's some fabulous providers out there that do a really good job of that business, right? CWB National Leasing comes to mind. I mean, they've been doing it a long time before CWB bought National Leasing. But, I mean, I think their credit box starts at like $5,000 and goes up to, a couple $100,000. But when you're looking at those micro tickets, you're really almost throwing the collateral out the window. It's not even really a focal point at that point, because you're just looking to write so much business on covenant and just get the diversity of your portfolio up that you're almost kind of betting on the industries and the markets that you're operating in. I mean, at that dollar figure, you're never going to go get it. It's going to cost you 10 times as much to just write it off and move on to the next one.
It's like a leasehold financing.
Basically. Totally. And the distillery equipment being that food manufacturing. And again, as a lender, I think there's a lot of good business out there. We've just never really understood it probably well enough or had the funding capabilities to do big enough, facilities where someone would say, hey, I need you to, step in and do this new line. When we were at General Electric, we had a fabulous manufacturing team that would basically say, hey, if you have $5 million in CapEx, I'll do it, but I want to take out everybody that's already in play, and I want to grab the buildings, and I want to do all the other stuff, and they would just do a wrap. And then that way you're getting kind of a full turnkey, lending package. And I think it's also, as a lender, you either want to be the smallest creditor at the table or the largest. Being kind of in that awkward size of you're relevant but not that relevant. When companies are in trouble, they're always dealing with the biggest guy. And generally the smallest guy becomes such a nuisance that they deal with him too. If you're in that awkward place somewhere in the middle and something goes wrong, generally that's not the best place to be.
When I've seen one deal in particular, small deal, it was like $1 million, and they had they were an equipment rentals business. And so you folks were in there and competition was in there, and there were a couple of GSAs in there, and we were just trying to put working capital financing in place. We were trying to replace a factoring facility, and getting subordination of those GSAs was a right hassle. And not necessarily with you folks, but just some folks were really protective of those GSAs. So I guess my question there is, when does it make sense to put a GSA in place on equipment financing?
Well, I mean, there's two parts to your question. I'll answer the one with maybe a little bit of humor first, is that every lender on the planet, from my perspective, gets, euphoric, and it's the parties and it's the hyper focus on winning and getting it on the books. How many celebrations have there ever been for the servicing team? Hey, the customer called in 100 times and we got it right 99 out of 100. Like, that just doesn't happen, right? My servicing team does an amazing job of servicing our accounts, but, again, do lenders celebrate that aspect of their business? It becomes that hassle of like, we've already got this on the books. It's already there. It's earning us money. Now it's something we have to do that, it's an unfortunate side of lending. It's just like, managing that aspect. The second part of the question is, customers should generally be quite, hesitant to ever grant that type of security. We'll have it in specific circumstances where we have, 15 different contracts and we just want the ability to tie the collateral to all the different payment streams and cash flows. But generally, again, we try to go in with the guise of, not the guise, like the honest expectation of the client that, hey, we need this because of the magnitude of investment we have. We're the biggest creditor. But, we do carve-outs for inventory, working capital, all that stuff all the time. Some lenders are not that way. It's just that, it becomes a very intrusive document. And if you get into bed with the wrong person that takes that level of security, they can become an absolute roadblock to doing any other financing. And the real unfortunate part of, again, lending is, when people want to send stuff out to lawyers and get opinions on it, and then all of a sudden it's a very simple document turns into a circus where, it takes a month to get everybody to agree on something. And then at the end of the day, who's eating that bill? Mm-hmm. The client is, right? So I totally hear you. In those particular cases, again, I think borrowers need to understand that a general security agreement is literally pledging right, title, and interest of everything in the business, except real property. to a lender.
Yeah, and I get how you end up there too. Like if you're a smaller company, like you said, you just want a contract. Like I kind of need the money today. You're like, I'll sign whatever you need, and you might not even get your lawyer to really agonize about the GSA. You might just say, I don't know, just review everything else or whatever happens. So I certainly understand that, and you're not going to be changing your working capital providers all that often, but when you do, it's such a rat's nest. It can be such a rat's nest if you've got 3 or 4 GSAs.
It is. And honestly, again, with our borrowers, we try to educate people on exactly what security means and what these documents mean. And I'm sure you've lived through this, in your financing days that, even sometimes when you talk to customers about, I need that waiver, I need that subordination, I need that this. And in a lot of cases, you say, do you know what that means? And they're like, I don't, but I know that you need it, right? And it's like, well, it's because so-and-so has a general security agreement, or they have an interest in your accounts receivable and your inventory. And they're like, people ask the honest question, because sometimes as lenders, we take for granted that the borrower knows as much about the financing aspect as we do. Well, man, I mean, it took me a long time to get my feet underneath me in this business to understand all the different mechanics of security and registrations and priority agreements and all that. And I think sometimes we make the assertion that the client is as knowledgeable about that as we are. But I mean, still to this day, we say, hey, waivers, we need this, we need that. And generally, those are the biggest holdups to getting a closing done, right?
Yeah, it's a pitfall. We're in a bit of a bubble to a certain degree, right? Like if you hang around a bunch of other lenders, then you're all using the same glossary. And customers vary wildly, right? Like some get it, some understand, have the same glossary, others don't. And there's a chunk of those that just pretend like they do. So you don't actually even know if there's a misunderstanding until like you're wildly behind schedule for whatever reason. And
yeah, we try to describe it to customers in this sense of like there's things inside my control and things outside my control. And here's the things that we're going to need your help with. And generally speaking, I mean, we're happy to send those documents, waivers, insurance requests out to those other creditors, or you can do it for you. And we generally tell people, generally speaking, your creditors are going to answer you faster than me because you're a client.
Yeah,
I'm another lender. So again, we try to elicit their participation. But again, not everybody's created equal. There's certain parties out there that take those types of security instruments, and then all of a sudden it's, well, I took it for this reason, and if I knew that this was going to happen, then this is the way I would have reacted. And yeah,
we had on that deal that I was talking about, we had Dave Holmberg. He pretty much quarterbacked most of that. And, you guys have a pretty decently sized facility with this customer. So, it's worth, I guess it's worth your time in a way. But honestly, like this, there were way too many emails over this. And Dave didn't get paid for any of it. Like, he was such a stud.
I was joking with him this morning if he was wearing his Kevlar to work, and he confirmed that he hasn't taken it off for the last 7 years.
Ay.
So it's a great point, is that the individual that works at the organization generally is the difference maker. And, I think unfortunately sometimes, banks take the, the brunt of all of it, but, there are good people working inside banks. They're just, sometimes a slave to that system, but the truly exceptional people are the ones that are doing all that heavy lifting in the background that generally the client never feels, right? It's just, I deal with so-and-so because he's that great, and they don't know that, all the magic that gentleman or that lady is pulling off behind the scenes, to manage all the politics in the organization and, pushing on things when they need to be pushed on. And those are the people that doesn't really matter where they go or who they work for. I mean, they're the difference that the client is feeling.
I definitely know a couple of RMs that take a lot of credit. Which industries are the hottest for you right now? I mean, this is a weird market, obviously.
Construction continues to be strong. Infrastructure spending, housing, roads, bridges, all that good stuff has been a good place to be. Still continues to be a good place to be. Touch wood. Logging, we have a fairly good sized forestry book that's stabilizing. It's, we think it's going to be a good winter. Think that the markets are showing some support, which is positive. Energy markets are still strong. We do a lot of lending in that area as well. I would say really the only industry that is showing, a lot of distress is over the road transportation. And I think, again, a lot of that I still attribute back to COVID. Where, we're feeling the hangover that, the government spending and stimulus and all that just prolonged. When people were spending a lot of time at home and there was a lot of, stimulus and money being pumped into the markets, people were buying things. And stuff had to get moved from point A to point B. And so you had a big run up of capacity. Carriers were adding trucks and trailers and depots and terminals and all that good stuff. And all it takes is a couple of percentage point, downturn in spending and less goods and services moving. And then all of a sudden there's too much capacity, not enough freight, and, rates start to come tumbling down. So that industry is definitely going through some challenges, but, it's like anything. It won't last forever. There's still good deal flow in that industry. And, for guys like ourselves, there's probably good opportunities to help some of those operators, restructure and kind of, figure out a way to, manage the storm and, hopefully come out the other side a little bit stronger than where they maybe are today.
Would you deal with many, I don't know the word for it, driver operators? Owner operators?
A little bit. It's not a super large focus for us, just for no other reason than our direct team in Western Canada really does well in kind of more of the rural outskirts. We're not a huge downtown lender, we would say. And generally our thesis is just that, you kind of got to get out of the busy grind of a downtown environment where you're competing and rubbing shoulders with, everybody and their dog on every deal. And so again, we're very relationship based, less on the transaction based. And a lot of that, originations of those owner operator deals either happen at the vendor level or you have a program or a target to really kind of go after that stuff. I think there's a lot of good business there, but we don't have a ton of exposure there now.
If you had to guess, how much of the business consists of equity takeout on equipment?
Oh, good question. Off the top of my head, probably 10 to 15% of what we're doing, something like that. We kind of have, again, CapEx guy, operator goes out, buys a truck, buys a gravel truck, buys a hoe, buys a whatever. That's still a good chunk of the business. Equity takeout, 10 to 15%. Merger acquisition has become a pretty big part of our portfolio where, we work with clients that want to go buy somebody else. That's a great business for us. You want to talk about
where they're purchasing on asset value?
Asset value, we've done share purchase and asset purchase. But yeah, again, it's got to have a, kind of a strong equipment element. We've actually started taking some residual positions on real estate to bridge gaps and be able to kind of make loan to values work. But we still need a good chunk of equipment to, to have a way to margin those into our facilities, but definitely have some more flexibility to look at the real estate elements. But the M&A is kind of a fascinating space. I mean, the last article I read was, a few $1 trillion in Canadian wealth is going to change hands in the next 10 years. And honestly, like those deals are just, they're fun. You're helping somebody get into business or you're helping somebody buy a business. The ability for an independent lender to offer that value enhancement is strong. We've closed those deals in 30 to 45 days. And that,
which would be a huge advantage, right? Because those financing can really get dragged out.
Well, even in our world, it's just, man, again, by the time you have all the professionals and advisors and everybody else weigh in and comment and structure and all that, it's, we finished one up that started in February, March and ended at the end of July. And it was supposed to end at the end of May. And again, it's just, things get hung up, things get stuck.
Stampede was in there.
Yeah, Stampede, yeah. Calgary shuts down. But yeah, again, great business for us. Speed kills. Nothing is worse for a transactional deal like that than time. Nothing gets better with time. You have a buyer and a seller that want to do something. They have a date in mind and they want to hit that date. And as soon as extensions and all that stuff start piling up, I mean, we've seen deals crater. Someone says, I'm done. Like, I'm not accepting another 30 days. Like, I'm out.
Yeah, everybody's a little skittish in those transactions, so those extensions are not viewed kindly.
Well, because usually it's unfortunately, again, if you're dealing with an institution that's got a big long process, generally it's tied back to the financing. And if the financing isn't committed, and at some point in time commitments don't even work. Someone says, "Is it in the trust account? Yes or no?" And if there ain't no money, there ain't no deal.
Yeah, fair enough. The real estate stuff, so the residual real estate, is that a new thing for you?
Yeah, it's we just have some more flexibility in the facility we launched that, we have the ability of, for example, standard lending criteria for cash flowing acquisition is some type of an advance against physically appraised OLV on the fleet. If someone says, hey, you know what, like generally there's some type of goodwill, blue sky, turns on EBITDA, whatever, that's going to create that gap. It basically allows us to go up to 100% of the fair market value of the equipment and use the property as basically the reason to do that. So it's just more flexibility to basically say, hey, we're still funding the equipment specifically, but we can then attribute some value to the real estate, whether it's a first or a second charge of, hey, here's the equity that we're going to be relying on to, over advance on the equipment assets.
So you're helping finance that goodwill component, but you still have tangible asset coverage behind it, right?
Yep.
Yeah. And how do you feel about real estate in rural Saskatchewan? I'm asking for a friend.
You know what? Honestly, real estate for us is still, more of that residual boot kind of viewpoint. Like
again, you'll never lead with it is the point. Yeah.
No, we kind of knew enough. Like GE had a real estate group and a division that was, around towards the end, and again, I learned a lot of good things from working there. And one of them was just again liquidity of collateral. And those are why I think a lot of those deals end up going to local credit unions or BDC or somebody that really can step in and get comfortable with that location, that geography, that operator. Yeah.
So that's exactly. So I asked because we have a deal, and I forget how this ended up on my plate, but rural Saskatchewan, like super rural, like less than 1,000 people in this particular town. Okay. I didn't realize how rural Saskatchewan was. Like if it's not in Regina or Saskatoon, it's hard to find a lender for it. And we were we're trying to do an equity takeout to get caught up with CRA. Some stuff happened, and BDC looked at it, and they thought that we might be able to do something here. But here's the rub: we can't pay out CRA. So finding somebody that would take on that property was a real grind. We ended up finding somebody, a bridge lender that would do it at 50%. So we had to scrum up a bunch of extra real estate, frankly, to make this whole thing work. But it was shocking. Like if you get booted out of the house, the local credit union, your financing options are pretty limited.
Pretty skim, yeah.
Yeah. So it's trapped collateral. Like might as well be worth zero.
On something for you guys to be mindful of, and this is just I have one personal experience with this that has me make this statement, but I think the days of CRA being patient are quickly coming to an end. I have a customer that I would also consider a friend, and again, some transgressions and some mistakes and all that, but situation is what it is, and CRA is definitely demanding their money back, and the repayment term is 12 months. It's been appealed. It's gentleman's really trying to push to find some leniency. But I mean, if you look at the situation, there's just the payment that they're imposing on them. There's no ability for it to be made in a long-term basis, right? And it's the first time we've actually seen them really push to a point of like, are they trying to basically tell this guy to just throw the towel in? And so again, we believe that those days are probably coming to an end.
Was it just COVID patients?
I think so. Yeah. I really do. There was a dawn in an era a long time ago. When I first got into the business, there were different bridge lenders, that don't exist today. But anything to do with CRA went right to bridge. Like lenders did not fund tax arrears. And if you were a borrower that had tax arrears, it was like you were just painted with that brush. And CRA wasn't the most easy to get along with at that point in time. And over the last couple of years, and I think specifically with that empathy from COVID, and maybe that pressure that, again, we don't want to put undue harm on entrepreneurs, which I totally empathize with. But we're just seeing that patience start to dissipate.
We had tried to pay out CRA when I was at the bank, and we were really close to doing this. And then we had to sit down as a team and look at each other. And we had to ask each other, do we really want to do this? And it was the credit score of 495 that really made us say no. So sometimes, you get so caught into trying to make a deal work. Sometimes you need somebody to stop you and be like, let's just take a breath for a minute. So I'm glad that person stopped us. But
495, wow.
Yeah, you gotta. Apparently, there are tricks to get it up pretty quickly, but that are beyond me. But yeah, you gotta work to get it down to 495 for sure. Hey, so we're 40 minutes in. Let's maybe we'll wrap it up for you. How about some advice for somebody that is considering equipment financing, looking for sort of a suitable partner, things to consider, et cetera?
Honestly, like I would just think of the questions that, you want to ask somebody, right? Like if you and I were going to sit here and look at doing some business together, I just want to get to know you as an individual. I'm a big believer that the individual, generally speaking, is the difference maker. Do you believe that the person sitting across from the table is honest and genuine, and you can take what they're saying as a commitment, and hey, like there's some character here. And just ask questions on, what happens if I pay out early? What happens if I can't pay? Like, kind of knowing your options going in, know what the temperature is. And also what kind of servicing am I going to get once we get to yes? A lot of our transactions have multiple pieces of collateral, in these refi workout deals, sometimes there's 300 assets on a contract. What's it going to look like if I want to go and sell something? And how do my payments adjust? And how do you guys treat that? And last but not least, I'd be asking about, are there annual reviews? Are there covenants? Are there anything else that you're going to come back and ask me about? And again, one of the niches that us independents have, generally speaking, is we don't do any of that, right? So we charge a little bit more, but we also don't come with anywhere near the burden and the headache of, reporting and covenant compliance and all that stuff that goes with it. So,
obviously I like cheap money as much as anybody. Unfortunately, my mortgage is variable right now, but I really do advocate a lot for this idea of covenant light financing, right? Because generally speaking, if your deal's large enough and you're at a traditional lender, you're going to have at least probably at a minimum one covenant, right? You're going to have a cash flow covenant probably. And the consequence of that, though, is that a covenant means a potential default. And I'm not saying decline every potential covenant that's thrown at you, but consider the value of a slightly more expensive financing solution that actually has no handcuffs on you.
It's that, and it's also, it's true committed credit.
Mm-hmm.
We tell people all the time, like, I don't have the ability to call you back and ask for my money back. It's just not a thing. It's not built into my documents anywhere. I think, again, it's one of the features that a lot of the institutional lenders have had in play for a long time now. And there's been this almost, demand debt, but, we're in a good market, you're in covenant compliance, all that other stuff. All it takes is, lickety-split downturn in a market, an industry, an asset class that a lender doesn't like in their portfolio. And, the covenants are the hammer. Once you're at a covenant, you can get moved to special credit. You start dealing with people that might be asking you politely at first to maybe find alternatives, or what's your solution, or what are you going to do here? And again, those are just the impacts of having those covenants and those restrictions put over your head. So like I said, covenant light, from my perspective, as long as you can, is the way to go.
And committed financing, you're right.
Committed financing. And it's not that we advocate for, borrowers to be cowboys and do whatever they like, but, at the same time, do you want, to be answering to your bank or your lender or whomever it is every quarter, every year about this ratio, that ratio, why you missed, how you're going to get back on side, what's your plan? To me, that's just a waste of time.
And if you're in special credit, it's probably weekly or more.
Daily.
Based on an existing customer I have.
Yeah.
But where can people find you?
You know what? You can check out our website, www.dynamiccapital.ca. Great place to find us. It's got all the contact. It just got refreshed and updated. It's got our team all across Canada. Lots of people to connect with on there, depending on where you are, what geography, what you're looking for. But yeah, we're all over Western Canada. We've got some people up and running in Eastern Canada as well, and looking to grow, support Canadian entrepreneurs, and obviously put our capital to work.
Wonderful. Well, thank you for doing this. This is your first podcast, but you got another one lined up. So I'm happy to give you some training here. And
Hey, appreciate it. Thanks for the invite.
You did great. Thank you.
Thank you.